For most beginners, a stock chart looks like erratic noise. Prices spike and crash without a clear trigger, leading to emotional guesses that usually end in lost capital. But retail traders don't move these markets. The significant shifts are driven by institutional capital, banks and funds capable of moving millions of shares in seconds. Because this volume is so massive, it cannot be hidden. It creates structural footprints that are visible directly on the price chart. Tracking these players requires a three-step framework: identifying the microsignal, checking the macro context, and following a strict execution plan. Shifting your focus from predicting the future to reacting to this institutional evidence changes how you interact with the chart. The process begins with candlesticks. These are the microsignals that reveal the immediate battle between buyers and sellers within a specific window of time. Each candle tracks 4 points: where the price opened, its highest and lowest levels, and where it closed. When a sharp drop is quickly reversed by buyers, it creates a hammer. The long lower wick shows sellers were overpowered. An inverted hammer shows the opposite. Sellers push the price back down, leaving a long upper wick. Engulfing patterns signal a sudden shift, when one candle's body completely swallows the previous one, showing total control. The inside bar indicates a pause. Here, a smaller candle stays within the range of the previous one, showing the market is consolidating before its next move. While these shapes are the foundation, their meaning changes depending on where they appear on the chart. To see if a signal is valid, we look to the left to find the broader structural context. This is a market base, a zone where buyers and sellers are deadlocked. The price bounces within a narrow range because neither side has enough volume to break the other. When a surge of volume forces the price through the top of the range, it creates an impulse breakout, confirming a buyer's base. If price returns to this level, it encounters the same concentration of buying interest. In a downward breakdown, the range becomes a seller's base. The heavy volume at this level now acts as a ceiling that price struggles to move back through. These bases are the physical evidence of institutions accumulating or offloading massive positions. By aligning a micro-signal candle with a macro context base, we move from guessing to trading alongside established momentum. Execution begins when the price returns to retest a previously established buyer's base. In this scenario, we look for the footprint. If a hammer candle forms directly within the base, it indicates that buyers are active in the expected area. The trade is triggered only when the next candle breaks the high of the hammer. This move confirms that the upward momentum has actually resumed. To protect your capital, a stop loss is placed just beneath the lowest point of the hammer. If the price falls below this, the structural evidence is no longer valid. Some traders drop to a lower time frame here. Identifying a smaller support zone within the base can help tighten the stop loss even further. Combining these specific entry rules with defined risk management replaces a theoretical pattern with a repeatable process for protecting capital. The system relies on 3 layers: the pattern, the location, and the execution. Technical analysis isn't about knowing the future. It's about waiting for institutional footprints to manifest on the chart before you commit capital. This requires the discipline to wait for the market to build its structures, rather than chasing every move. Following a strict set of evidence changes a trader's relationship with risk. Subscribe for more systematic trading blueprints and share your questions in the comments below.